Something is shifting, quietly, beneath the headlines. While most investors are still watching yesterday's news, a handful of central banks have already made their move. Gold is climbing back toward levels that once seemed untouchable. Silver is coiling inside a pattern it has only formed a handful of times, in decades, and in Hong Kong. Right now, a new system is switching on, one that could quietly change who controls the price of gold forever. The Federal Reserve is boxed in, the stock market is more concentrated, more fragile than it was before the last two crashes, and the people who understand what's coming are not waiting. This is not noise, this is a signal. And by the end of this briefing, you will understand exactly what it means for your money. Now, before we go any further, I want to ask you for something. Not a favor for me, a favor for yourself. You know how, back in the day, if you found a good newspaper, one that actually told you the truth, one that got things right before everyone else did, you'd hold on to it. You'd make sure you never missed an issue. That's exactly what the subscribe button does here. So go ahead, tap it now, so you don't miss the next briefing when it matters most. And I'd genuinely like to know, where in the world are you watching this from today? Drop your city, your country, down in the comments. I read every single one. Now, let's get into it. For months, the mood around gold and silver had been quietly grim. Investors who followed the sector closely had grown tired of waiting. Prices had fallen, confidence had faded, and many people who once believed strongly in precious metals had started to lose patience. Some had sold their positions altogether, telling themselves they would come back later when things felt safer. But something important was happening beneath that discouragement, something most people were too frustrated to notice. When confidence in any market falls this low, there is very little room left for it to fall further. It can only really move in one direction from there, and that direction is up. Analysts who study market behavior for a living understand this pattern well. Extreme pessimism, they explain, often marks the exact moment before a shift begins. Not because someone rings a bell to announce it, but because the selling pressure eventually runs out. The people who wanted to sell have already sold. What remains is a quieter kind of market, one that is more sensitive to good news than bad. That is exactly where gold and silver investors found themselves. Sentiment had been poor for so long that it had nowhere left to go but improve. And now, according to analysts tracking the space, it was starting to do just that. At the same time, a bigger story was unfolding around the central bank and interest rates. For a long time, there had been fear that policymakers would keep raising rates aggressively to fight inflation. That fear had weighed heavily on gold and silver, since higher interest rates usually make holding metals less attractive compared to interest-bearing assets. But a new leadership tone at the Federal Reserve began changing that expectation. Analysts increasingly believed that this new direction would not be capable of pushing rates higher. At best, they suggested, rates might simply stay where they are. This shift matters more than it might first appear. Markets do not wait for official announcements before they react. They react to expectations. And once traders and investors began sensing that aggressive rate hikes were unlikely, gold and silver started to respond. Prices began to firm up. Analysts pointed out that this reaction had already started in the prior week, suggesting that informed money was moving ahead of the wider public. There's a well-known pattern that experienced investors watch for, one that has repeated itself throughout economic history. The best time to be positioned in gold and silver is not after a recession has already started and panic has spread everywhere. It is right before that recession begins, while most people are still distracted by other things. By the time a downturn becomes obvious to everyone, the early advantage has usually already been captured by those who prepared in advance. This is why some analysts believe that current conditions deserve serious attention. Several economic signals taken together point toward a slowing economy heading into the end of the year and into the following year. None of these signals guarantee a recession will happen. But history has shown that when multiple warning signs appear together, it is wise to pay close attention rather than dismiss them. For business owners and entrepreneurs, this kind of moment carries a different weight than it does for casual observers. Business decisions are rarely made based on daily headlines. They are made based on where the broader economy seems to be heading over the next 1 to 2 years. If a slowdown is genuinely approaching, then decisions made now about savings, about risk, about how a business is positioned financially, could matter far more later than they seem to matter today. This is the core idea shaping the story unfolding across the precious metals sector. Sentiment had fallen to levels that left little room for further decline. A shift in monetary policy expectations was already underway. And history has shown, again and again, that the period just before a wider economic slowdown becomes visible is often the most rewarding time to prepare, not the moment after it has already begun. What comes next builds directly on this foundation. Because sentiment and policy expectations are only part of the picture, there is technical evidence forming in the charts, patterns that have appeared only a handful of times in decades, and They are pointing toward a resolution that could shape the direction of silver prices for a long time to come. While sentiment was quietly turning, something else was happening inside the charts themselves, something that technical analysts describe as far more telling than daily price movements. Over a short window of just a few trading days, silver had begun climbing steadily, tracing a clear and consistent upward path. Analysts who track these short-term movements say this kind of sharp, sustained uptick often signals the early stages of a larger move, rather than a random bounce that fades within days. But the more important story was unfolding over a much longer stretch of time, nearly 6 months, according to analysts who had been mapping the pattern closely. Silver, they explained, had formed what is known in technical analysis as a wedge, a shape that appears when price swings gradually narrow, squeezing tighter and tighter like a spring being compressed. This particular wedge had been building since the start of the year, right around the time silver had touched its highest level in recent memory. Wedge patterns, analysts point out, always resolve eventually. Price cannot stay compressed forever. At some point, usually within a window of a few weeks, the price breaks decisively in one direction or the other. What made this particular wedge worth paying attention to was its shape. It was tilted downward, and historically, this specific downward tilted structure tends to resolve upward far more often than it resolves downward. That single detail, according to analysts, is one of the more reliable signals in technical trading. There's a second detail that matters just as much. Markets tend to continue in the direction they were already moving before a wedge forms. Since silver had been in a strong upward trend before this compression began, the historical tendency favors a continuation of that same upward direction once the wedge finally breaks. None of this guarantees an outcome. No analyst, no matter how experienced, can say with certainty where silver's price is headed. But when multiple signals point in the same direction at once, that combination becomes far more meaningful than any single signal on its own. Analysts describe this growing alignment as more than a coincidence. It reflects the same improvement in underlying sentiment discussed earlier, now beginning to appear directly in the price action itself. When confidence in a sector has been suppressed for as long as it had been here, even a modest improvement can create a large amount of untapped momentum, one that has not yet been fully priced in. Beyond the metals themselves, analysts also turned attention to the US dollar index, a measure that tracks the strength of the dollar against a basket of other major currencies. At first glance, the dollar did not appear to be weakening in any dramatic way. It remained above key levels it had held for some time, but when viewed across a longer historical stretch, spanning several decades, a clearer pattern emerges. The dollar has spent very little of its history sitting at current levels. Most of the time, historically speaking, it has traded lower. This detail carries real weight for precious metals investors because a weaker dollar has consistently aligned with stronger gold and silver prices throughout history. Analysts point to one especially striking period between 2001 and 2011 when the dollar index fell sharply. During that same stretch, silver's price moved from roughly $5 an ounce to $50 an ounce, a tenfold increase. While no analyst suggests history will repeat exactly, the relationship between a weakening dollar and rising silver prices has held up across multiple decades, making it one of the more dependable long-term signals available. There is also a deeper structural reason behind why this dynamic tends to repeat itself. Analysts explain that governments carrying extremely high levels of debt face a difficult choice. They cannot easily pay that debt back in full value without severe economic pain, so instead, many rely on a quieter method, allowing inflation to run slightly higher than interest rates over time. This gap, often called negative real interest rates, gradually reduces the true value of debt without ever technically defaulting on it. For gold and silver, this environment tends to be extremely favorable, since both assets have historically served as protection against currencies losing value over time. Taken together, these signals, the technical wedge, the historical dollar pattern, and the structural incentive behind managing national debt, form a picture that goes beyond simple speculation. It is a picture built from decades of recurring patterns, now converging at what many analysts believe is a critical turning point for silver and gold heading into the months ahead. While gold and silver were quietly building momentum, a very different story was unfolding inside the broader stock market, one that analysts say deserves just as much attention, if not more. On the surface, major stock indices appeared strong, even record-breaking, but beneath that strength, several respected market analysts had identified a level of valuation risk that they describe as historically extreme. One measure in particular stood out. It compares the total value of companies in a major stock index to the actual sales those companies generate each year. Historically, this ratio has averaged well below 2. At the time, analysts raised the alarm. It had climbed above 3, a level never seen before in modern market history. To put that in perspective, analysts explained that it would take every company in the index roughly 3 full years of total sales, handed entirely to shareholders, just to equal the current value investors are paying for those businesses today. Of course, real companies cannot do this since they have expenses, wages, and operating costs to cover. The comparison exists simply to illustrate how disconnected current prices have become from the underlying businesses supporting them. This level was notably higher than the peak reached during the dot-com bubble in the year 2000, a period widely remembered as one of the most dramatic market corrections in modern history. Analysts drew a direct historical comparison between that era and today, and the results were striking. They calculated that money invested in gold at the height of the dot-com bubble would be worth many times more today than the same amount invested in the stock market at that same moment. Despite recent pullbacks in precious metals prices, gold has still meaningfully outperformed major stock indices since that period began, a fact that surprises many people who assume stocks always win over the long run. There's a second layer to this story that analysts consider even more concerning than valuation alone, and that is concentration. A small handful of dominant technology companies now represent an unusually large share of the total value of the entire stock market. Analysts pointed out that these few companies alone are now worth more than the combined stock markets of several major economies put together. When so much value becomes concentrated in so few companies, the entire market becomes more fragile, since a decline in just a handful of stocks can drag down the broader index far more severely than in a healthier, more evenly distributed market. To understand why this matters, analysts pointed to a historical precedent from Japan in the late 1980s. At that time, Japan's stock market had grown to represent an extraordinarily large share of total global market value, a level of concentration rarely seen before. Shortly after reaching that peak, Japan's market entered a severe and prolonged decline, losing the majority of its value over the following years. Remarkably, it took several decades for that market to fully recover and reach a new record high. Analysts use this example not to predict an identical outcome, but to illustrate how dangerous extreme concentration can become once sentiment shifts. Analysts also reference the semiconductor sector specifically, an industry widely known for its boom and bust cycles. When comparing recent price charts of this sector to earlier periods, including the mid-1990s and the year 2000, the patterns appeared strikingly similar, each followed by a significant downturn. While no analyst claims history repeats itself exactly, these recurring shapes serve as a caution to investors who assume current gains will continue indefinitely. Taken together, this combination of extreme valuation and extreme concentration paints a picture of a stock market carrying significant hidden risk, even while headlines celebrate record highs. For this reason, many analysts argue that gold and silver should not be viewed simply as speculative assets chasing short-term gains. Instead, they should be understood as a structural hedge, a form of protection against exactly this kind of fragility building quietly within traditional markets. When history has shown that overvaluation and concentration eventually correct themselves, having a portion of wealth positioned outside that risk becomes not just a strategy, but a form of insurance. While retail investors were still absorbing the risks building inside traditional markets, a different group of participants had already been quietly making their move for years, and their actions speak with a weight that ordinary sentiment cannot match. Central banks around the world had been steadily accumulating gold month after month in a pattern that analysts describe as historically significant. In one recent month alone, reports showed that central banks purchased over 40 tons of gold, the largest single monthly addition in more than half a year, following another sizable purchase the month before. This marked the third consecutive month of notable buying within that year alone. What makes this trend especially meaningful, analysts explain, is who is doing the buying. Several nations had been consistent, repeated purchasers, including one country that had now extended its streak of monthly gold purchases past 20 consecutive months. Unlike retail investors, who often react emotionally to short-term price swings, central banks tend to operate on long-time horizons, guided by strategic reserve planning rather than daily headlines. When institutions with this level of patience and resources continue accumulating gold at a steady pace, it sends a signal that carries far more weight than short-term sentiment ever could. At the same time, a quieter but potentially more transformative shift was taking shape in how gold itself gets priced on a global scale. A major new exchange had been preparing to launch in Hong Kong, alongside a new clearing and settlement system designed to support it. This development positioned Hong Kong to compete directly with long-established pricing centers, including the London Bullion Market Association, which had influenced gold pricing for centuries, and the major commodity exchange in the United States. Trading volumes tied to this new exchange had already reached record levels in the days leading up to its launch, according to financial reporting on the story. Analysts argue that this shift deserves far more attention than it has received. For hundreds of years, a small number of Western institutions have effectively controlled how gold is priced globally. A credible new pricing center emerging elsewhere represents a meaningful change to that long-standing structure, one that could gradually redistribute pricing influence over time. Because this story does not fit neatly into mainstream financial headlines, analysts suggest it has been widely underappreciated relative to its potential long-term impact. A related shift was also occurring within the silver market specifically. Data on open interest, a measure of active contracts within the futures market, showed levels falling to their lowest point in nearly a decade, even lower than levels seen during silver's prior major bottom years earlier. Analysts interpret this decline as evidence that paper-based trading, contracts and futures, rather than physical metal, may be playing a diminishing role in determining silver's price. Instead, physical demand appears to be taking on greater influence. If this trend continues and open interest eventually begins rising again, analysts suggest it could coincide with renewed demand and potentially significant upward price movement. Taken together, these threads form a coherent picture rather than a collection of isolated events. A shift in monetary policy expectations, a technical structure in silver nearing resolution, a historically fragile and overvalued stock market, sustained institutional accumulation of gold, and a structural change underway in how gold itself is priced on the world stage. Individually, each of these developments might be dismissed as background noise. Together, analysts argue, they form a rare alignment, one that has historically preceded meaningful and lasting moves in the price of precious metals.